Good morning, lazy traders. I'm here to talk to you today about seasonal versus semi-seasonal trading based on the RSI and the Williams %R oscillator. I'm going to start with the relative strength indicator, the RSI, based off of the NASDAQ. Typically, what you see during seasonal trading is when you have the September-October crunch. That's usually when the fund companies, the mutual fund companies and hedge fund companies are doing tax harvesting, or they're doing various things to rebalance their portfolio, pay taxes, however that works out. But that's a lot of money that's actually putting a lot of downward pressure on the market, and it creates a buying opportunity. And this is what I call seasonal trading, because you see that in the fall, and then you also see it during the March-April time frame. Sometimes, though, in some years, you don't really get the seasonal trades that you can execute. And this is one of the examples of this year where the September-October is pretty much out of the picture. Typically, when I look for a seasonal trade, I look for the RSI, the relative strength indicator, to reach a point of oversold of 30. And with that oversold of 30, I also expect to see a drop from the high of the NASDAQ down to about a 10 to 15% drop, somewhere in there. And this right here in August would have been a prime example of a drop that I could have taken, but I didn't, because I didn't know what the Fed was going to do with interest rates, whether they're going to maintain the interest rates at 25, a 25 basis point cut, or if they're going to do a 50 basis point cut. Because I didn't know, I didn't want to take that risk, because if they did a 25 basis point cut, then the trading action during September, October likely would have been about how I would have expected it to turn out. As it was starting to show about September 6th, you can see that the NASDAQ dipped down to about 16,600. And at that point, the enthusiasm was starting to return to the market. And then when the rate cuts hit, it was more than expected, and then the markets jumped even higher. And then following that, you had a lot of positive economic information and data was coming out. Unemployment has been dropping. It's down to 4.1% as of right now. So that's adding a little bit more lift to the market. There's a lot of money in the sidelines coming in. This really isn't quite the opportunity that you're looking for. But if you're just basing it off the RSI and the numbers, you would be looking for a 30 on the RSI, and then you're looking for a range drop during the September-October time frame of about 10 to 15%. In the March-April time frame, I'm looking for maybe about a 5 to 8% drop in the overall market. That's typically a smaller drop, because you've got individual investors paying their taxes and taking out money to do things, whatnot, to pay those taxes. So with the RSI is a much smoother, much more calculated relative strength indicator. It's more based on the long trade, but it's based on momentum as well. So there's a mathematical equation that goes on with the RSI. It's a 2-point mathematical equation. The first point is 100 minus 100 over 1 plus average percent gain over 14 over average percent loss over 14. That result is then taken and used into the next equation, which is 100 minus 100 over 1 plus the previous average gain times 13 plus current gain over previous average loss times 13 plus current loss. So the RSI only nears 100 or 0, so it's either overbought or oversold in increasingly trending markets. So the stronger the trend, the more likely you're going to get those numbers to come in. That's what the RSI is for, and this is what we call seasonal trading. The Williams %R oscillator, and I use the Russell 2000 for this, and the reason why I use the Russell 2000 for the Williams %R oscillator is because the Russell 2000 is only growing at about 8.5% per annum, and because of that flatness, and because it does have quite a bit of volatility to it, it becomes pretty attractive to trade it, especially if you're using the Williams percent hour oscillator. So the Williams percent hour oscillator is more of my semi-seasonal trade, and that's calculated by highest high minus the close over the highest high minus the lowest low. The highest high is the highest price in the look back 14-day period. Lowest low is the lowest price in the look back 14-day period, and the close is the most recent close. The Williams percent hour oscillator used in this strategy, I'm looking for points of interest where you have a high in the Williams, so you're not owning anything, but at the same time, you're looking for your next buy-in point. And if it's outside of the seasons, you're looking for a 5% drop, because you could get a 2% drop or a 3% drop in the Williams in the price action, but you won't. You'll see the negative 100 in the Williams, but you won't see the bottom for another 2 or 3 percentage points. So it's a little bit of a measured approach. All of it really is kind of a measured approach. But for the Williams percent hour oscillator and doing outside of the seasons, I usually wait for percentages of drop that are equal to about 5%. The overall attempt here is really just to beat the RSI with itself. Is to beat the Russell 2000 with itself. The NASDAQ, I'm not trying to beat the NASDAQ. It's not a part of the goal. That's part of just my dividend capture trade strategy. Sometimes I pause on some dividend capture trading and just sideline a little bit of money into the RSI on the NASDAQ, because I'm expecting a crash anyway. So I'm doing some seasonal trading with some percentage of the money, and then the other percentage of the money is going towards the NASDAQ on the RSI. And that's how that part of my trading strategy is developed on dividend capture trading. The Williams percent R is just kind of sort of a side project. I really haven't explored that too much. But in the coming videos, in the next video, I will be doing a video based on what my gain loss is so far with dividend capture trading, what I've done so far to this point. After that video, then it's going to be trading. Some of it's going to be experimental, like with the Williams, but most of it is going to be from experience and previous experience. So with that, I bid you adieu and stay lazy.